Thank you very much, Charlotte, and thank you all for enduring a central banker and a central banker who's about to start off at an event that is all about the future. I'm going to start with the past, perhaps inspired by this historic setting. And I want to take you back a century ago when John Maynard Keynes, exactly a century ago, he resigned as a delegate to the Paris Peace Conference over his concern about the potential impact of the scale of reparations that were going to be part of the Treaty of Versailles. Keynes came back, he wrote The Economic Consequences of the Peace over the ensuing couple of months, and in it he marveled that before the war, and I quote, "The inhabitant of London could order by telephone, sipping his morning tea in bed, the various products of the whole earth, or venture his wealth in new enterprises of any quarter of the world that fancy might recommend." Now, such global trade and portfolio management were made possible by the new technologies of the day, the telegraph and the first transatlantic cable. And if you replace telephone with tablet and tea with turmeric latte, you have not the start of the 20th century, but the start of the 21st. We're at a time when the second great wave of globalization is cresting, the fourth industrial revolution is just beginning, and a new economy is emerging. And you're here because that new economy demands a new finance to serve the digital economy, a new finance to support the major transitions underway across the globe, and a new finance to increase the financial sector's resilience. A new finance with products that are more cost-effective, that are better tailored, and more inclusive. And you, the UK's fintech companies, are creating this new finance. We've just heard from Charlotte how this sector leads in talent, drive, and investment. But you can't do it all on your own. Your efforts will be much more effective if you have the right conditions in which to innovate and the level playing fields in which to compete. And that's why a new finance demands a new Bank of England. And it was in this spirit last year at Mansion House I announced that Hugh Van Steenis would lead a review of the future of the UK financial system, including recommendations for how the Bank of England should respond. And in 2 months, Hugh will publish his final recommendations, and the bank will announce a number of concrete steps to create an environment for a more resilient, effective, and efficient financial system. And what I wanted to do this morning was to preview that approach by highlighting some recent measures that the bank has been taking consistent with this strategy. Our strategy is to enable innovation and empower competition while doing our core jobs of ensuring monetary and financial stability. And the levers we have to do this are our hard and soft infrastructure. So when I say hard infrastructure, think of things such as our real-time gross settlement system, or RTGS, which lies at the heart of the UK payment system. When I suggest soft infrastructure, think of our rules, regulations, and standards and how we apply them. So to illustrate what this can mean in practice, I want to consider 3 examples of what the bank is doing to provide a platform for private innovation, to serve the digital economy, to finance the major transitions in the globe, and to increase the resilience of the financial sector and, indeed, our economy as a whole. First, we all know that the very nature of commerce is changing. Last year, 1/5 of all sales in the UK were online. Next year, it will be 1/4. The new economy is more inclusive, offering easier routes to markets for firms both large and small, and greater access for consumers both near and far. This new digital economy is placing new demands on the financial system. Consumers and businesses increasingly expect transactions to be settled in real time, checkout to become a historical anomaly, and payments across borders to be indistinguishable from those across the street, whether real or virtual. In parallel, as you know, big data is opening up new opportunities for more competitive, platform-based finance of small and medium-sized enterprises, with search and social media data supplementing traditional metrics to unlock finance for SMEs whose assets are increasingly intangible. This new finance demands a Bank of England that is as open to new providers as it has been to traditional players. And here's one way we're changing our hard infrastructure in response. The bank is in the middle of a rebuild of RTGS, that system I just referred to. Now, it's a system that processes over 600 billion pounds of payments every single day. And until recently, only commercial banks had direct access to it. And alternative payment service providers, or PSPs, had to route through those banks. That made sense in an old financial system arranged around a series of hubs and spokes, but it's increasingly anachronistic in a new distributed finance that's emerging. So we're now making it easier for a much broader set of firms to plug in and compete with more traditional providers. Responding to demands of fintech providers, some of whom I can see, the rebuild of RTGS will provide API access to read and write payments data. And 18 months ago, we became the first G20 central bank to open up access to our payment services to a new generation of non-bank PSPs. Since then, 5 have become full members, and a growing pipeline of around 20 firms are currently exploring how to join. We believe wider access will improve services to UK households and businesses, and it will bring financial stability benefits by increasing the proportion of settlement in central bank money, by diversifying the number of settlement firms and driving innovation. And of course, it will drive innovations in ways that this audience can anticipate and we will appreciate. My second example of how the bank is providing a platform for private innovation, and this is the core point, we can change our platforms for access. You will provide the innovation in ways that we can't precisely foresee in order to serve the economy. But my second example concerns the financing of major transitions that are currently underway in the new economy, such as the rise of rapidly emerging economic powers and the evolving response to climate change. And let me take the transition to the low-carbon economy in particular. It's going to provide an enormous reallocation of capital and massive investment in infrastructure, on some estimates as much as $100 trillion globally over the next decade. The firms that anticipate these developments will be rewarded handsomely. Those that fail to adapt will cease to exist. This will have enormous ramifications for the financial system and for financial stability. And that's why the bank is transforming, in this case, our soft infrastructure. Recognizing the need for adequate reporting of climate-related risks and opportunities, 4 years ago, the bank helped catalyze the private sector-led Task Force for Climate-Related Financial Disclosures, or the TCFD. The TCFD has now led to a step change in the demand and supply of climate reporting, with over $100 trillion of assets now demanding TCFD quality disclosures. A market in transition is being built. In parallel, the bank has been overhauling its supervisory approach, and earlier this month, we published a supervisory statement and policy statement, which together set out our expectations for banks and insurers regarding their governance, risk management, strategic resilience, and disclosure of climate-related financial risks. To support capacity building and the development of best practices, the PRA arm of the bank has just established the Climate Financial Risk Forum to work with firms and the FCA to develop these skills. The bank is also working with central bank and supervisory colleagues from around the world in the Network for Greening the Financial System. In particular, we're looking to improve climate risk management at the core of the global system. Our priorities include the development of a small number of high-level climate stress scenarios that can be used in system-wide tests. And next month, the PRA will require insurers, as part of market-wide stress tests, to consider how their businesses would be affected in different climate risk scenarios. So by adapting our soft infrastructure in these ways, the bank will help ensure that the UK financial system will not only be resilient to climate-related risks, but almost more importantly, can take full advantage of the enormous opportunities in the transition to a low-carbon economy. Now, my final example of how the bank is building a platform for private fintech innovation considers how general-purpose technologies, such as advanced analytics, can increase the resilience of the financial system itself. As you know, as much of life moves online, a tremendous trail of data is created. Indeed, more data was created in the past year than in all years that came before. And this data is creating enormous opportunities for the new finance to serve customers better and to manage risks more effectively. To these ends, the financial sector is investing heavily in the cloud, machine learning, and AI. Banking is already the second biggest global spender on AI systems after retail, and is expected to spend a further $10 billion on AI by 2020. AI-enabled solutions are increasingly important in fraud detection as well as automated threat intelligence and prevention. And as some in this audience are exploring, there's also significant potential in credit assessment, wholesale loan underwriting, and trading. And such advanced analytics are also likely to lead to changes in the way that the Bank of England conducts supervision. Now, the PRA promotes safety and soundness based on forward-looking, judgment-based supervision. Our job is to identify the key risks that firms face and set supervisory strategies to address them. And as a process, you can break that down into 3 simple steps. First, rule setting and reporting. Secondly, analysis and monitoring. And thirdly, setting and communicating a supervisory strategy to address those risks. And each of those 3 aspects of supervision is amenable to automation, machine learning, or AI to some extent. Consider the first, rule setting and reporting. As I'm sure you're all aware, at over 638,000 words, the PRA rule book is longer than War and Peace. It's also somewhat less interesting and infinitely more complex. So what we're doing is we're using advanced analytics to understand better the complexity and indeed the interconnectedness of those 638,000 words. We want to identify ways to simplify our rules and to make compliance with them easier for firms. And to explore ways to make reporting more efficient and effective, we're running a pilot with the FCA on machine-readable reporting requirements that firm systems could interpret and ultimately that firms could automate regulatory data collection. These initiatives are goods in and of themselves, but they're also ways of creating the potential to unlock the power of AI to do supervision better. So let me conclude. When a century ago, Keynes marveled at the new possibilities, a decade of wealth creation followed, but its gains gave rise to imbalances in incomes and trade. And when combined with the economic consequences of the peace, disaster ensued. Today's new technologies, the new economy, and the new finance have the potential to unlock more sustainable and what Charlotte just emphasized, more inclusive growth. Consumers can have greater choice and better targeted services. Small and medium-sized businesses across the country can access new credit to grow. Banks themselves can become more productive, and the financial system overall can become more resilient. Most fundamentally, unlike in Keynes's time, the gains from new technologies will not be limited to men or captured by denizens of the city. The new finance will be more inclusive, allowing everyone to be better connected, better informed, and more empowered. And to do our bit, so that you can do your bit, we're adapting our hard and soft infrastructure to help create the conditions for such innovation to flourish, to promote the good of all the people of the United Kingdom. Thank you very much.